All right, so the Bank of Canada has done it again. We sound like a broken record here, but we are looking at another 0.25% increase. We're recording this a little bit late for a specific reason. We've been waiting for some inflation data and ultimately wanted to just assess the impact on the rate that the increase that happened last week. Receiving the inflation data today, there has been some positive news. So as much as we are talking about a negative and a bit of a shocker for some, but not for others that the rate was increased. We're going to touch on some positive in the fact that inflation has cooled again to 2.8% in June, and just what that means for us going forward. So we are going to shy away from predictions to a degree, but just toss it around. All four of us are here today to just share our opinion and where we think things are going to go.
Well, opinion is it hurts. It sucks. Yeah. I mean, you said it. It's a broken record. I guess it's nice, positive spin zone. It's only a 0.25% hike, so it seems like if there are rate hikes in the future, it seems they're on the smaller, more typical, rate hike percentage that we're used to seeing outside of, the last year where we saw a lot of those oversized rate hikes. So everything, are they done? Are they going to go again? The next meeting is until September, I believe. I think it's around the 13th. We got, as Dean mentioned, inflation information that came out today. That was certainly positive. So that would support the Bank of Canada maybe not hiking rates, but there's another data set that comes out in August, I guess, which, my opinion, they're probably going to lean pretty heavily on that one more than they are June's report that we just got. So I would say good news, small win today, but I think the big battle coming up is just that August inflation report, and we'll see where that comes in at.
Interest rates increasing is obviously a negative thing in so many angles, and that's really our government and the Bank of Canada's only tool to drive inflation down. And what drives inflation down is people are essentially being hurt financially, right? You're not spending as much money. There's a lot of different markets that go into that, but everything that we're trying to drive down is also a negative thing, right? So we kind of need things to get worse before it'll get better. And I think everyone can probably would agree to this, but I think the average family that had a bit of a nest egg, most of those people have gone through it, right? And rates are getting to a point where it's extremely challenging for anyone that's been in a variable line of credit, even unsecured debts like lines of credit. Some car loans are fluctuating, right? So it's definitely, I think that we're getting to the point where things were okay for a lot of people for the last 12 to 14 months. And now a lot of people are kind of starting to get on edge, right? Just financially. So as much as that's a terrible thing for a lot of people, I think that just shows you that inflation will probably continue to fall to a point where the Bank of Canada wants it. And again, predictions don't really mean a lot to me anymore because everything's been pushed out or adjusted so frequently over the last 12 to 18 months. But they're now calling for inflation potentially not getting into the zone that they want it until mid to late next year. But based on what we're seeing, I mean, I would hope that it's going to be quicker than that because that's when rates will start coming down.
We're only really seeing the effects of last year's rate hikes now as well. So these last 2 quarter-point increases they've done the last 6 weeks, we may not even feel those until early next year. So I'm seeing a lot of clients that are being laid off now. I've talked to a lot of blue collar workers and trades that have been with the same company for 14 years but have been laid off recently. So I think we are coming to that scary R word, recession. I think it is coming. And when we see a recession, we generally see rates come down because money needs to become readily available. So I think there's a lot of good news today with the CPI being close to that 2% range that they're trying to hit. But there's other bad indicators that things have been going up. So I guess time will tell, and there's no right or wrong answer anymore at this point.
We've gotten to the 2% range, having a 2% number behind, but in front of this, it's important, right? It's where they wanted to be. And then that, again, it's a small win. It's a little bit earlier than they predicted. And what does that mean going forward? Maybe we can just toss some potential options to consider going forward now if you are in a few buckets, like struggling with your payments, looking at if you're a variable rate client, looking at is there potential relief coming down the road. Hard to predict a rate drop that's going to make much of an impact anytime soon, and And in a lot of cases, to Tyler's point, we're going to have to look at more data before a decision is made on that, and we should be probably preparing for another increase, which is really unfortunate and hard to say. We hope this is done, but if you're a variable rate client and you're looking to potentially find some relief, the options would honestly just be looking at refinancing, restructuring, or locking into a lower rate, and those are the ones that are top of mind because it hurts them immediately. People that are coming up for renewals, we have a lot of clients reaching out from a renewal perspective, looking at rates that are much higher than what they had for their previous term. Those are individuals that we highly recommend, shopping, looking at your options, looking at strategies, looking at restructuring, looking at potentially just lowering debt in general, right? These are all things that we should be considering. So just maybe we can toss that around, like what should you be looking to do if you're in one of these buckets?
Well, I just think of people coming up for renewal. If I'll touch on that, especially if this is maybe your second renewal. Maybe you bought a place with a 30-year amortization mortgage. Now you're down, 25 years. You renewed for another 5 years, for example. So you got 20 left. I mean, people need to understand your maturity date is an option to kind of redo everything, right? So, and I've had this conversation with a lot of people that really wanted to stay on that schedule of paying the mortgage down inside that 30-year time frame, but just seeing what their renewal payments would do to their mortgage, they've said, I would rather pull this back. Maybe we'll take a shorter term, 2-3 years. We'll pull it back to 30 years, and then reduce the payment, and then just try and save and invest elsewhere, or use other prepayment privileges to slowly tack down that amortization. But I think it's just important to kind of hit home that your maturity date is your opportunity to kind of either change lenders, change your amortization. This is assuming you can qualify, but it's like a fresh look at your whole mortgage, your mortgage scenario, and it presents the most options with the least amount of fees because there's no penalties when you come up for maturity. So, from a renewal perspective, we've hit home on this a number of times. The sooner you get in touch with your bank or broker, the better, just to start kind of sussing out options, because we're treating renewals almost like purchases now, where we're getting people a rate locked in 120 days. Almost consider that like your rate hold, your pre-approval. And then as we get closer to completion, if rates drop, well then, hey, if we've got lender B or C or D over there that's substantially better than where we have you now, okay, well, we're going to get you a second approval, or maybe we're going to move you over here. And at least it's giving you constant options 120 days out.
Yeah, and qualification is a big part of that. Just like a purchase pre-approval, like if you're locking in and rates are 5.5 and over the next 2 months they go to 6.5, you might not actually qualify to move your mortgage anywhere, and now you're stuck with your current lender, right? Which just limits you completely. Re-amortizing to 30 years is extremely common, but also a lot of people just mindset wise don't want to. You don't want to restart, what have you. Like, it doesn't have to be your forever situation, and there's a lot of people that probably aren't in their forever home, and most people, when you sell and buy your next property, you're going to start at 30 years anyways, right? So I think for most people it's just getting through the next 12, 18, 24 months of what we're dealing with, right? And we've seen a lot of people get pretty creative, like, maybe someone doesn't have the option to refinance and re-amortize or pull money out. We've seen people that are taking on like students, right? Foreign students that can pay anywhere from $1,000 to $1,500 a month. People, pulling a bit of equity from their property and building a basement suite because they don't even really need it. Like, that can drive rents are crazy high, especially right now. For a 2-bedroom suite, you can get $1,800 to $2,000, which can dramatically change the situation. And even something such as, if someone has $30,000 in savings, just taking a chunk of that out, like nobody wants to do that, but if you pull $12,000 out of your savings and you supplement your income by $1,000 a month, like, that gets you through a full year, and $1,000 a month can dramatically change someone's lifestyle or their struggles, or allow you to not take on debt, right? So it's interesting. We're seeing a lot of people just get creative just to make sure that they can get through this. And no one wants to work more than they have to, but we've seen people get second jobs and working on the weekend, whatever, just to make an extra $1,000 a month, right? Like, it can go a long way. It's not forever, and if it allows you, like I said, to not destroy your credit or rack up debt, I think that can go a long way. So I guess my point is just be open-minded.
I think too, the other scenario that I've really seen recently is clients looking to restructure their variable rate mortgage, but then also looking at what they can consolidate with the equity. And I've seen a lot of clients where their payment was going to go up $900, but because we rolled in their car payment, we're not looking to add another $900 of income. They're just taking from Peter to pay Paul. And it's really making their life a lot easier. Whereas before they were, going to be renewing their loan, and they had their truck payment, and then their payment was going up another $1,000, and they weren't sure how they were going to come up with an extra $1,000 being on a fixed, guaranteed hour salary income. So just being creative and talking to us and seeing what your options are is going to help you in the long term and probably make your life a little bit easier for the time being.
We do sound like a broken record here because we've been tossing around a lot of these items time after time with these rate increases and just the uncertainty. But the one thing I just want to continue to hammer home is it does look like the end is near. The big R word is scary for some, but it can be relief for a lot of others, potentially with potential rate hike pauses on the horizon and maybe even drops. And one thing to just point out is, this isn't a prediction by any means, but it is important to note that we are going into an election year next year. A lot of the predictions of rate drops coming are looking at like a 2025 timeline. And that for me is hard to believe, regardless of the data, knowing that we're coming into an election year. And so it's just something to consider, something to watch, something to assess in general. Your vote obviously means something. And as the vote, looms on the horizon here, it'll just be interesting to see how our government reacts leading up to that. And that's something to watch, regardless of just data coming out.
Yeah, I guess, again, I'm looking at this positive spin zone. The closer you are to the end of rate hikes means the closer you are to cuts. Inflation, again, this is probably the 10th time we said it. The report came in light today, which is good, but it's not just here. Our biggest trading partner down in the South, the United States, their inflation reports came in a couple of weeks ago. That was soft as well. And where the Bank of Canada, so, what are these hikes? What do these numbers mean? Like, there's a band that the Bank of Canada wants to hold interest rates, right? And we're exceeding that. And they exceed that band when they want to actively slow the economy, right? So they're in what they consider a restrictive zone, which means they don't want to keep it in that zone for an extended period of time. So eventually when these things bite and start to come down, like their plan is to lower that rate. So, when it happens, who knows? But the closer we are, again, to the end, it means the closer we are to cuts. So
yeah, I mean, if you just look at historical data, which is tough to put any weight on too, because this isn't, it's not the exact same situation, but they're essentially driving the country into or very close to recession, at which point they need to lower rates to stimulate the economy, right? Like, this is what happened with COVID, if everyone remembers. Full-on lockdown, like, full concern was the economy crashing because businesses weren't open, what have you. They dropped rates dramatically. It created what we're dealing with now, in addition to printing money, and now we're just on the back burner of that. So I mean, it's taken a lot longer. It's far more dramatic than anyone expected. So nothing good about the situation, right? So I think from here, it's just, how do you get through it as best you can? What do you need to do in your life to just get through this, to make sure that you can maintain your home, and there will be light at the end of the tunnel eventually.
This government has proven to be very flamboyant and showboating, and they like to be like, look what we're doing for you. So I kind of lean in the same boat as Dean there, and I do think we'll see rate cuts hopefully next year. That is my prediction, only because I think this government's going to be like, look what we're doing for you now, and we'll see what happens.
Well, I'm sure everyone will hold you to that, so we'll leave it at that, and we'll just we'll move on to the next one. I mean, there is another rate meeting coming up in before the summer's over, and we'll stay tight on that. We'll stay tight on the reports, and we'll continue to provide our opinions on these matters going forward. So thanks for listening, and we'll be back.